the problem you have is you don't know you've got a bad accountant until you've got a bad accountant.
How could I know if my accountant's doing a good job?
Well, the easiest way is to probably reflect and review, like everything else. And another accountant is able to look at something and say, yeah, most of that stuff's going, being done right. Every accountant's going to pick up little bits and pieces and nicks and knacks and tiny changes that they would do things differently. The question you've got is
it legal?
Yeah, is it legal? And also the person that is obviously reviewing your stuff might be motivated to obviously onboard you as a client. And so they're going to try and tell you everything you want to hear. So the difficult part that you always have is finding the person that will look and review your books for you and provide you with an honest opinion.
And so you're saying that business owners should get external accountants just to review, but obviously you have the danger of having someone finding it's kind of like when I have a designer design. This happens. I have designers design something for me, clubhouse, house, or my apartment or whatnot. And then you get a new designer, another designer comes in and goes, "Oh, that's wrong. That's wrong. I would have done it differently." Of course, they're going to say that. It's almost their job to redesign it for you. But
yeah.
But one way people could get around that in regards to accounting is having a friend that is an accountant, someone that's non-biased. And CUB members obviously have the value of having lots of people that they could call upon for non-biased help. For example, would you be happy to assist members?
Oh, absolutely. Yeah. I'd be more than happy to take a cursory glance over something confidentially and just provide them with input to say, yep, that's materially correct. There's bits and pieces that you could definitely look at changing, because there definitely would be. I promise you. And I promise you, if someone looked at my stuff, they'd probably find things that they'd change as well. It's similar to like designers. Everyone's got a different opinion on certain things. And some clients like to run really close to the sun, and some are really want to put their head on the pillow.
But how do you do that without offending your accountant?
Yeah, it's always it's the constant process.
You got to have it's got to be your reason outside. See, that's why I've been meaning to put together a board for ages, and I honestly reckon the most valuable thing a board would give me is the ability to deflect blame to someone else. Yeah?
Absolutely.
No, it's not me. It's the board. What are you waiting for me? I've got to listen to them. I'm the CEO. I've got to speak to the board. They're telling me to do that. I've got to ask you. It's not my fault.
Yeah, good cop, bad cop.
Yeah.
Absolutely.
I think that's half the board's purpose. It's just being a bad cop.
That's right.
Yeah.
That's exactly it. Look, it's a really hard one, and it's navigating personalities and people, and trying to figure out, well, how can I review what's going on and make sure that things are right? And it might be as simple as asking your accountant, say, hey, do you have somebody that I can recommend and pay for an hour's just to review? Someone and trust, who's not going to go and take the client or do anything like that, and work that way. So Daniel Hakim sets up CUB under his personal ABM, goes and makes $1 million this year. He pays his first 180 grand. He pays tax at between 0 and 39%. But once you make 180 grand or more, you pay tax at 47 cents in the dollar under your personal name and your marginal tax rate as an individual. If you were to set up CUB as a company, then you would pay tax at 26%. So then all of a sudden you'd only pay $260,000 in tax rather than closer to $470,000.
Oh, so that's more so for the so when there's one-man bands and things like that, they're setting things up in their personal ABNs.
Yeah, but people have still even set up businesses in trusts and other sort of legal structures that allow people to split their income, but it still someone's still got to pay the tax.
If CUB takes the money, CUB pays what's the corporate tax?
It's 26%.
Yeah. But if I'm to take that money out of CUB, I still have to pay the difference between CUB's tax, which is basically me paying tax anyway because it's my company.
Yeah, that's right.
And I still have to pay the difference between CUB's corporate tax and my personal tax, which would be 40 whatever %.
Yeah.
So you end up losing it anyway, no?
Absolutely, but it's a timing thing. So you've got these $180,000 bands each year that you can use to get money out, and you've got family, friends, and bits and pieces that you can also distribute to
through a trust.
And what you're trying to do is maximize the use of these bands on an annual basis. Because if you don't use it, you lose it, right? On the 29th of
because the trust has to spit out money.
Yeah, on the 30th of June, if you don't use that person's income band, then when it rolls over to the 1st of July, it's done.
You can't do it.
You can't do
so
it
why
again.
don't you explain that to us? Why don't you explain this system of having a trust in
Yeah.
order to distribute the wealth of the business?
What I always do with clients is I start at what I call the Rolls-Royce structure, being the creme de la creme, which potentially might be a company owned by a trust, or two companies, company owned by a company owned by a trust, and for various reasons. And then you sit there and go, well, that's going to cost you X amount to set up. That's okay, but that's not feasible. What can we do now to get a similar benefit without spending all of that money? And you sort of work backwards. But the one thing that's really useful is when you're setting up these businesses, if you can set up, the owner of that business or your ownership side of that business into a discretionary trust, then that's going to give you the ability to split your income between yourself, your wife, your family members. Absolutely. So all of a sudden, if you earn $400,000 a year worth of income and profit out of that business, tax on 400 is going to be 180, but tax on 104 times is not. It's not.
So I
sort
can
of
send
45
Laura
grand.
$100,000. I can send my brother $100,000. I can send my nephews $100,000 each.
That's right.
And they pay much less tax with $100,000.
Yeah, or you might.
But the money comes to me.
Or you might grab some of that money and say, I'm going to set up a new business, or I'm going to do a property development.
Laura just looked at me like, yeah, send me the money.
Or you might choose to roll that money into a different project, like a property development or something like that. You can distribute that money directly into that investment so that pays 26% tax rather than 47. And then, yes, you're going to have a problem when that profit comes out, but you've at least got the opportunity.
But you've used the money now. You've got access to more money now because you haven't paid the tax on it now. So I can then go invest that money into a new venture, and I've got more of it to invest.
Yeah, that's right.
When I want the profit, I've got to pay it, but at least you've delayed paying it and you've utilized the money better.
That's exactly right. If you run a company and you qualify for various concessions, and you've got to be open for a certain amount of time, you've got to have a certain level of turnover and bits and pieces. I won't go into it all, but you can qualify for the concessional employee share scheme arrangements, whereby you can provide shares or the options to purchase shares to employees now. So that if you eventually sell down the track, they have sort of a piece of the pie along the ride.
Stock options.
Yeah, that's right.
That's what it's commonly called, isn't it?
That's it. In America, they call them stock options, yeah.
Oh, what do we call them?
Oh, we call them,
shares.
the share options.
Sounds like confectionery shares.
Confectionery,
Yeah.
yep.
Shares that are unhealthy for you.
That's right.
And so how they work, basically, is that, let's say I want Laura to have, I want to grant Laura, she's worked at CUB for 6 years, I want to grant Laura 1% of CUB. If CUB is to sell for $1 billion, Laura would get, oh God, please make my maths correct, $10 million. Is that?
Yeah.
No, sorry, she would be able to sell her shares worth $10 million minus what they were worth when I gave her that 1%.
That's
So
exactly
if they were
right.
worth $500,000, she gets $9.5 million.
That's exactly right.
And what's good about that is the team don't have to put money in. They haven't actually got the equity yet. They've got the option to sell the equity.
That's right.
But they can do it without having to invest any money.
Yeah, that's exactly right. And these are the things that your Googles and your Facebooks
All
and
the tech
Amazons
companies
used
do
to
that.
use, or were the only ones using for quite a while. And America's got different rules to Australia, but the same thing was for the case of any big sort of ASX listed company or anything like that. And these things are now trickling down to smaller businesses, and people are using that as incentives to keep staff around.